Good morning to everyone. I'm hoping you're all fine. On one fine Sunday morning and ready to take a course of today. I welcome you all to yet another session of Advanced Taxation. Today we are making a formal start of our course. The last week we have met and have spent most of the time of the course in introducing this course. Yeah, good morning. A lot of information I had it, which I had communicated to all of you, general guidelines, which will enable you to get the benefit out of this whole distance learning course the next 4 or 5 months. I have introduced the whole course of advanced taxation, the exam pattern, the course contents, the way things are going to be tested, computer-based exams, not many things we had to share, and I have. I remember in the last 30 minutes of the course, we had been able to take a soft start. Mainly, we will start investing the time on discussing the topics, as each of our session will be for 4 hours. So lot many things on one particular session, we will now have to start learning it as from today. So let me connect myself to the board. We remember, according to a plan, we had decided to start off a course with capital gains tax, and then we will go into inheritance tax, then income tax will come. Means we have taken the side of individuals first. Companies or corporates will be done in the later part of the course. Also, the one thing that I have to give you an update of, the exam date has just changed. In the past, for all the past many years, the exam of ATX used to be conducted on Tuesday. This has been the case in past 5 to 6, if I can take myself back to can remember easily 5 to 6 years if I go back. But it has now recently changed to Wednesday. So advanced taxation will not be on Tuesday, it will be on Wednesday. In fact, one of my students has updated me, and I owe a big thanks to that student. It used to be always on Tuesday. Even the exams coming up in September 2023, not your exam sitting, but those they have opted for the advanced taxation in September 2023, they will still be appearing for advanced taxation on Tuesday. But for the first time for December 2023 exam, they have changed that to Wednesday. And then I came to check and verify by myself on a website. I see that change. So the other day, the date that we had 5th of December, Tuesday, now should change to 6th of December. Keep that date into your mind. Instead of 5th of December, it will be 6th of December. Okay, not the whole week has changed, not that it has gone to second week, just on Tuesday. It used to be always in the past. Now it's going to be as from December on Wednesday, which means it will be on 6th of December instead of 5th of December. Okay. The board is connected. Capital gains tax introduction. I don't see much of the work we have done. We started off with the definition of capital gains tax. A little bit of a talk we have had it in regards to proceeds that usually take cash, but when the case is the case of gifting an asset, one has to use the market value because the gift, we do not have proceeds. And especially when an asset is sold up to a connected party, actual proceeds are ignored and we come to replace it with the market value. And you know the whole reason behind of doing that. This is where the time the course was ended and needs to start the course of today. Exactly from that mark, we have left the course. Let me bring up that introduction pack also to correct that in front, rather just to talk about this in air. Okay. So after that, I guess no such confusion will be there, anyone will be confused about, as I have corrected the same thing into my live course and which is becoming a part of this recording also. So everything is clarified. I guess no such confusions whatsoever. And being a student, you keep on getting those reminders from ACC. I don't get those reminders. You people keep on getting it. So you, by anyhow, something that you will be informed of throughout once the ACC sends you the email in regards to your standard deadline for payment, early deadline. So you keep on getting those reminders from ACCA, which will be okay. Definition, pro forma. So within that pro forma, the gross disposal proceeds is finished. That is the whole section of usually takes cash, but exceptionally when an asset is gifted, market value has to be used, or when the asset is sold out to a connected party, market value has to be used. And the illustrations on all of those three possibilities I had been able to give it. That is a case of sale to a random party, proceeds were in fact the figure of cash. This was the transaction of gifting. So the market value was used, being the part of proceeds. A case where an asset is still being disposed, but to a connection. Cash of 10,000 was actually exchanged, but that later was replaced with market value, deemed proceeds. And you should be understanding the whole reasoning behind that. Connection, when is involved, the asset is sold at a price usually less than to market. So it in effect reduces the gain, and in effect tax saving of tax happens, which the authority, they mind it. So they make the rule to prevent this to happen, that okay, when it comes to the computation of capital gains, market value will then be used. Next to that is incidental cost of disposal. And it does not require to have any paperwork. It does require to have only a minute talk. Incidental cost, incidental to the sale of an asset. And examples could be like advertisement, discounts, delivery cost, agency commission, valuation fees, survey. All of these examples I'm quoting are the examples of selling costs, that these costs are associated just because the reason of sale transaction. If the sale transaction does not take place, the company or an individual would never end up incurring auctioneer fees, surveyor fees, valuation fee, discounts cost, transportation cost, agency. All of these costs are directly associated, deducted. So after deducting the incidental cost out from the gross disposal proceeds, we definitely will end up getting what? Net disposal proceeds. Still can have a look into that section that writes state agent commission, valuation fee, auctioneer's fees, advertisement cost, delivery cost. All of these costs are in association to sale, deductible from the gross balance of proceeds to arrive at net. What comes next to RWA? Cost of acquisition. This will require to have definitely a formal paperwork. So what is it? Usually, what do we have to take? The cost of acquisition, usually purchase price. Usually a purchase price, a price that has been paid previously in order to acquire that asset, becomes the cost of acquisition for later to be used while computing the gain on disposals. And this can be understood by looking down to this example where Mr. A selling off an asset to B, asset disposed, and this has been disposed for the proceeds balance of 30,000. No matter whatever the cost Mr. A has incurred in buying or gain, we must have to assume ourselves as Mr. B buying an asset from A for 30,000. So to us, it must have been a cost of acquiring an asset, which in fact is what? The purchase price. So for Mr. B, it is the price that he has paid in acquiring, must be the cost of acquisition. Tomorrow, tomorrow, I do not mean to say Monday, literal tomorrow, means any time in the future, next year, a month after, 5 years after, whenever he would sell it, the cost of acquisition to use will be the one that he has paid previously in acquiring that asset. So what is the cost of acquisition we will end up using is in fact the price he has paid in acquiring that asset previously. So that's what I was telling you, that yeah, it usually take what? Purchase price. Cost of acquisition usually takes purchase price, a price at which the asset previously was being purchased at. It's pretty obvious. Even if I was not making that case, you would have understood it without this much of detailed explanation, but everything has a reason. If I have explained this case to you very formally, it has a reason. The next case will be only understood if you understand this basic case of sale purchase. Fine. So if I'm Mr. B, to me, the cost of acquisition is in fact the price which was being paid previously to acquire an asset from someone, which is 30,000. Let's go to change this example to an example where rather it was a gift previously. So let me rub off those few of those facts. Asset is not sold, in fact, was gifted. And the market value on the day an asset was gifted was 45,000. 45, not 95. So in a transaction of gift, you should not be forgetting that as far as the donor's perspective is concerned, donor is the one who gifts an asset. Market value is used for the purpose of computing the gains. Is it? So I'm using it as our previous understanding. We're using it as a previous understanding. Market value. So if for Mr. A, it has been considered as the market value, proceeds, it must be considered as cost. It's a bit of a lag into a screen. I don't know. The system is not creating some or the broad. Fine now. Yeah, probably the cable of my microphone was a little. Okay, so where was I? For Mr. A, it has been considered as the proceeds. Same has been considered as the cost of buying an asset, but the truth is neither the Mr. B has paid it nor the Mr. A has received it. But assumption wise, deemed proceeds for Mr. A is 45,000 becomes the deemed cost for Mr. B. When tomorrow he will sell this asset to someone else for whatever the price, the same cost will then be used for the purpose of computing his gain. The key thing to notice is that the cost of acquisition this time has turned out to be the market value of an asset on the date of the gift. This is what you have to understand, and I hope you have. That cost of acquisition usually takes purchase price, but occasionally can even take this. And you can best understand that case if you have understood this normal case on the way first. Good with that. So market value is used when the same asset was acquired as a result of gift previously. When it was acquired by purchasing, then purchase price will be the cost of acquisition to be used. But when it was acquired as a result of gift, the market value of the gift will then be used as a cost of acquisition when later this asset will be sold, the purpose of computing the gains. These cases are quickly revisable. When it comes to your side, you get the copy of this file that I'm preparing it for you. And you hardly take probably 30 seconds to read this whole case and then this case. And ultimately, you have the better chance to contrast the two. And you'll be able to spot the difference of two. Okay, this solution is by how far different from this. The main difference is of this cost of acquisition. In one case takes the purchase price, which in the other case has started taking the market value of an asset of the gift. And that is how the way it's been explained over. Yes, it usually takes the purchase price, but when it was purchased previously, but when it was gifted previously, market value is then going to be used to be a part of cost of, and I've given you the whole explanation of that how. While probate value is the same case. Probate value is a value of an asset on the date of gift. So we don't call it as market value, we call it as probate value. Case remains to be the same. Imagine Mr. A has today died and inherits that asset to Mr. B, which means gift an asset to Mr. B on death. So the market value that has been spotted on the day of death will rather be called as probate value. So where the MV is used, I will change that to PV. Nothing otherwise will change in it. Gift in the life is simply called as gift. The same gift on the death is called as inheritance. So market value of an asset on the day of gift is called as market value normally, but the same market value on the death day is called as probate value. So these two cases are similar. That was the first one, which needed to be contrasted with this second one. And I have done my best to show to all of you the difference in the contrast of both, which means we are also ended ourselves with the cost of acquisition. So quickly, we work one thing, we move forward. We cannot stuck ourselves with one small thing and then spending an hours on to. Yes, with a lot of patience, I'm explaining you, not you can see me being too much hurried on completing this and that. But once enough of the talk we have had, we move forward. Incidental cost of acquisition. Just the way an incidental cost in regards to the disposal, you have understood this will be in regards to acquisition. Any cost that you as an individual incur over and above to the purchase price at the date of purchasing an asset, like legal cost, some sort of non-refundable taxes, transportation and handling cost, that will be topped up into it. Incidental to acquisition, if the asset was never acquired, this cost would have not been incurred. Then comes the enhancement expenditure. Likewise, in accounting studies, enhancement cost, extension cost, improvement expenditures are capitalized. So that's what we are also exactly doing over. No rocket science into it. You know that the improvements, extensions, and enhancements are always capitalized into the existing cost of the asset. So same will be applied to computing the gains. If later on your building has been extended by constructing further 2 stories over to the existing 5 stories, so the cost of constructing the extra 2 stories will be topped up into the cost of existing 5-story building. Repair and maintenance costs, we do not take it because those are not considered to be as enhancements, repair and maintenance cost. So this is where we are, and been able to understand a basic way of computing the gain. And that all is written like delivery cost in regards to an acquisition of asset, while enhancement expenditure could take an expenditure in shape of extension, improvement, or enhancement. Let's do this second application quickly to cover up what we have just understood. Quickly, let's this requires us to compute the capital gains. On 1st of July 2022, Sam had sold a villa to her sister for 35,000, must have been the balance of cash, although the market value on that day was 80,000. Sam had acquired the villa back in 2016 for this much, acquired the villa, so must have paid the price. That price that he has paid is 29,000. The legal fee on acquisition was this much, which is incidental cost of acquisition. The agent fees for the sales total 5,000, must have been the cost of incidental in regards to disposal. And then adding a room is an extension cost. So nothing special, except we will go to prepare that pro forma single-handedly by our own self. Next to that, there will be an incidental cost. That should be the balance of net disposal proceeds. Then there's going to be an incidental cost in regards to the acquisition. Then it will be an enhancement expenditure. So all of that stuff is given. Just go to plug it in. 800 should be the incidental cost of acquisition. For the room is 15,000. We have the cost of acquisition needs to be fixed in. The cost of acquisition is given as 29,000. The incidental cost in regards to sale is 5,000. And the only thing that needs to have our good attention is the sale of an asset to whom I have highlighted sister. Now, sister is one of our connection, relative. And when an asset is sold up to a relative, the proceeds are ignored and we come to use the market value for the sake of computing the gains, which is what in this case I will do. If I had gone actually, I would have taken 35,000 if I had gone actually, but not to be, since it's a connection. So needs to replace it with market value. Intentionally, I'm doing it so that you will come to realize that there's something important. I'm doing it over. Canceling it off and then replacing it with the market value. Intentionally, I have done this way. So now the gain that will be worked will be according to the market. $80,000. So early days of the course, we're dealing with basics, but these basics, they have a long-term impact. And if you are not going to respect them, you will be at nowhere to learn those complex aspects when we will step in. Last time I told you that these lecture notes are not divided in a way that some chapters are on basics, some are on complex. These chapters, they are a mixed blend of everything. Means within that first introduction chapter, there are a lot of newish aspects. You will come to see it even in the course of today. It's embedded together with it. So that is the end of this question. Let's get down to the third one to try and complete that also quickly. John sold a house for this much, costing them around 45,000, was extended that back in November 17th at the cost of 70,000. The agent for and the solicitor fee for the purchase total 1,500. He sold his grandfather's watch for 20,000. He was inheriting that watch on the death of his grandfather in December 2020 when the watch was valued for 13,000 pounds. So there are two assets being disposed. So I will need to maintain two columns, the one being for the house, the second being for the painting. The watch, house and watch. So I'll have to probably copy and paste this whole thing to save a bit of a time. Yeah. And can start fixing 100,000 has been the proceeds of the disposal of house, costing them around 45,000. Extended that at a cost of 17,000. For the purchase, the incidental cost is 5,500, and in regards to sale, it's 3,500. The watch has been sold for 20,000. No incidental cost in regards to watch and extension. The only thing that needs to be fixed it in is the cost of acquisition. So did he acquire a watch? No, he was rather gifted by his grandfather on the death, which means inherited. So in inheritance, the market value of an asset on the day of death is rather called as probate value, which in this case is this value. And I will go to use it as a deemed acquisition cost for the son. Son has never paid this much price to acquire it, but it's deemed acquisition cost to a son. And therefore, we have ended up using to get this answer. So 100,000 minus 5,000 collected minus 45,000 minus 17,000, the figure turns out to be 33,000. So do we really have to consolidate? Depends on one thing, and that one thing I can add into, you know, that this tax year, like accounting has its own year, financial year. Same way the tax has its own year that starts on one specific day, ends on the one specific. The applicable to your the exam attempt is 22-23, which starts on 6th of April 2022 and 5th of April 2023. So to see which tax year these gains they are belonging to, they will be assessed in, they will be recorded in. We just have to come and observe the date of disposal, which in this case is 15th of June. 15th of June 2022. Both the disposals, in fact, have taken place on the same day. So I'll have to just come and see if they belong to this tax year or not, which they certainly. So when I'm confident that this gain is going to be assessed into tax year 22-23, then I will only get the license to add them both. Else, I will not. Common sense or not? If one of the disposal takes place in one tax year and another takes place into another, then how can we possibly add them both? Only when you have made sure that they have been disposed in a same tax. What has been the day of disposal of this 1st of July 2022, which also going to be the gain of tax year 22-23. Fine, let's move forward. What is there on the top in the pro forma? Now, what comes next to our way are the reliefs. And these reliefs, we will go to work into our further aspects chapter. Further aspects, which is a next chapter of capital gains, not in this. So we will put this topic on a hold. till the time we will get into capital gains tax further aspects. There we will go to see. And there are 9 of those reliefs. 9. Too difficult it is going to be. Some of those reliefs you people have seen in the past, like rollover relief, business asset disposal relief, gift holdover relief, but mid principal private residence relief, letting relief, you probably have remembered their titles of, but there are plenty of more, about 9 of them. Further aspects, we will work into it. So that means we are all free to start our work onto losses then, capital losses, current year and brought forward. So can come to make 2 cases down under. Case 1, where there has been a disposal of 2 assets and whatever is in the body. In first column, we have ended up getting 1000. In the second, I have ended up getting 400, but that is negative, can happen. And both of those disposals, they have taken place in a same tax year. So this is, by the definition, is called as capital loss. Why not? It's a negative figure. And to be precise, it's called as current year capital loss. Why? Because this is the loss that has arrived in a current tax year we are in. So it should be called as current year capital loss. How to relieve it? Needs to offset it against the capital gains of the same tax year. So by offsetting, the net answer that I have got overall is still a figure of capital gain, which is called as net capital gain. Which is called as net capital gain. That is the first case of it. Now let's go to make the next case within which we will come across to the situation where we will have an overall loss. Quickly, everything I'm working and everything you have a paperwork. Things are difficult when lots of things I talk about in air and I don't give you any transcript of it, then becomes difficult. But everything that's going on, you have got a transcript. You have at the end of the day the whole whiteboard work that even sometimes you do not have a time to watch a recording. You just can refresh yourself with those solutions, with those whiteboard works only. The case number 2, within which let's try to shuffle some figures. Let's make that figure to look like a little bigger figure, 2000 negative. And the other one, let's take that as positive. Or I can keep that figure to be a positive 1. And this can be a negative 1. And let's try to make it 3100 negative. There's still a capital loss and a current year capital loss. And we still have to do the same. We'll have to try and offset it with the capital gains arising into the same tax year. So when I came to the maximum amount that can possibly be relieved is 2000. It means the portion of the loss that could have not been relieved is 1100. And that is what we call it as still capital loss, but it's now called as brought forward capital loss. So any portion of the loss that could not be relieved, that is called as brought forward capital loss. And this is the reason why we call it as brought forward loss, because we have no choice but to carry it forward now. Since in this tax year, we do not have any further gains to offset it. So we have no choice but to throw it into next tax year. So it's called as brought forward capital loss. 2000 could have possibly been relieved. 1100 could have not been, now needs to be thrown into the next tax year. I can even write the rule of law down below. This will be carried forward. This will be carried forward to offset it against the capital gains of the future tax years. Now, how many of those years we can carry it forward? That's infinite. This is going to be for infinite number of tax years. There is no limit to it. 1, 2 tax year, infinite. So while they are carried forward against capital gains, we only can offset, not against any income of individual like trading income, property income, employment income, savings income, dividends income, just against the capital gains. That is a case 2 of it. Then comes the discussion of annual exemption. We have one question on losses, but because that question takes the treatment of exemptions also, so we should better get ourselves done with the annual exemption so that together we can apply the both into that application. For a tax year, the limit of annual exemption is 12,300 pounds. This much gains are exempt. How? See some examples down below where sale proceeds of the disposal of asset is 50,000 and the cost of the same asset was 30,000. So we've ended up getting a gain, which is 20,000. Now to make these gains taxable, needs to deduct an annual exemption. Now the figure that is now becoming ready to tax is this figure 7,700. You're supposed to pay a tax on that, but now we will end up paying tax on it. So our gains have become tax-free by this much. And this limit is fixed for a tax year, and no one will ask us to deduct. We by default have to make these gains taxable, must done thing. Okay, the second possibility in the same case that you need to also have the knowledge of is this possibility. What if the gains are not plenty to absorb all of that exemption? Suppose the cost is 40,000. So while deducting that 40,000, the gain of 10,000 has been found. So we will end up subtracting the amount that the gains are possibly there to absorb. 10,000 is the maximum that we could have possibly deduct. So any amount of annual exemption that could have not been relieved, it's called as unrelieved annual exemption, which is 2,300 equals to a waste. Cannot do anything further about. The maximum that we can possibly deduct is the amount of the gains those are there to absorb. Any portion of that exemption that has not been relieved, the waste. Understood? Moving forward, making another case where there has been a disposal of 2 of those assets, the proceeds, the cost, the gain, randomly fixing those figures into it. So now if I have to make these gains taxable, I will have to subtract that exemption one-off, not against each of the assets. It's annually once available, not if you have disposed 5 assets in one tax year. Needs to consolidate to deduct only once this figure from. That misconception, if you had it, I even have clarified. That pretty much ends up the talk of annual exemption. You see, minute by minute, you have started to become a more knowledgeable than you were 30 minutes, 45 minutes ago, 50 minutes ago when the course started. Although it's a revision, but still you do not carry that knowledge with you while you come into advanced taxation. And this quickly, we are just working it along. Tax-free exemption available to individuals in the tax year on disposals. Only one exemption is available on all disposals that you already have understood. What do I mean to say? This is the limit for this tax year. And if any part of the exemption is not utilized, will be a waste. That was a discussion of loss. The loss that has arrived in a current tax year is called as current tax year loss. Needs to relieve it against the capital gains arising into a same tax year. And we did. Then we come to carry it forward indefinitely against the net chargeable gains for future tax years. You people already have seen me explaining that to you off. It's a formality. When I come back to look into the lecture notes, I always try to give you this sort of confidence that, look, I'm covering it all from here and it's readable since I already have had my words onto it. So you will not find yourself stuck over here, because by the time you will be reading this, you will be having that feeling that you know what is the meaning of that, because you have got a proper explanation already in advance on it. The loss of the previous tax year is known as brought forward because this loss comes from the previous tax year. So we call them as brought forward. How to relieve it? Against the capital gains of the future tax years for indefinite number of years, they can be carried forward. One thing that requires to have the attention of ours is the one that I have written it in bold letters, even in capital letters, that when the losses are carried forward and we relieve them against the capital gains of future tax years, it cannot waste the exemption of that tax year. So we will have to keep in check if we are compromising on the annual exemption by relieving the capital loss brought forward. If yes, we will have to try and restrict it. We will try to give the annual exemption a preference over and above to the brought forward capital loss. So how that restriction thing we have to come and apply in a very nice manner. In application 4, we can see the whole figure work and will be convinced about if it is fine. So current year capital loss can be relieved fully. Blindly, you can relieve the whole, but for the brought forward loss, you must have to give it a bit of a thought that, okay, let me check if I'm not wasting exemption by deducting the capital loss brought forward. If not wasting, fine, let it. But if you're wasting, then there you have to bring in that restriction, which by taking a proper figure work, I can explain in application 4. So A and B, both of them, they have made their gains and losses for the 2 of those tax years. In a chronological order, we will have to start off with the previous tax year first. Then we'll come down to the current tax year. And these are the 2 of those individuals. So I'll have to go case by case, individual by individual. So let's just pay attention to this side only. This is Mr. A and Mr. A. To start off with, we have tax year 21-22. And then we have 22 and 23. They've provided to all of us with capital gains. And we have capital losses. So in which tax year are we into at the moment? We are into 21-22 tax years. So standing it into that tax year, this must be called as current year capital loss. And we definitely have to come and relieve it against the capital gains of the same tax year, which I did. This is called as net capital gain, against which needs to subtract an annual exemption. Okay with that? So while you deduct the current year capital loss, you really do not bother to check exemption is wasting or not. Just deduct it as it is, even if you waste the part of the exemption. This case does not have any brought forward loss, because brought forward loss is the case when the part of the losses have not been relieved. So the losses have fully been relieved. So no chance that this person will have a brought forward capital loss. Next year, let's repeat the whole pro forma and we'll come to just change the figures. We'll save plenty of time. 30,000 has been the figure of gain. 30 and 14. The exemptions 1, 2, 3, 0. 1, 2, 3, 0 minus 16,000. The figure turns out to be 3,700. So the case of Mr. A is smooth. It does not have any brought forward loss. Twice of the time, you people have seen me producing that same kind of a solution. But applicable to Mr. B, we will have the brought forward loss. So you'll get the chance to learn the treatment of brought forward loss with the Mr. B. Okay, here you go. Let's rub off all of those figures and changing that title to Mr. B instead of A. Yeah, the figure is 6,000 for the capital gain and the loss is 11,000. So I will have 6,000 over here to write. What is the maximum we can possibly subtract? 6,000. Now this will create what? A brought forward loss. The portion of the loss that we could not relieve. 5,000. See, 11,000 was the loss and could have possibly been relieved by 6. So the portion of the loss we could not. That is brought forward loss. And this will be thrown to the immediate next tax year, which is the 22-23. Let's first go and take the data of 22-23 tax year, the capital gains of this tax year, the capital losses of this tax year, because you must have to deduct the current year capital loss on the way first. And then it will be the figure of brought forward capital loss very next to. The sequence cannot be disturbed. The first comes the current year and then comes the brought forward. And then comes the annual exemption also. There now we will come to finally apply that restriction thing. See, imagine if I deduct the whole brought forward loss of 5,000 from here, considering the fact that 22,000 is the figure of the gain that can absorb my current year capital loss brought forward, fine. But this will compromise one thing. Annual exemption would start wasting. See, 22,000 minus 8,500 minus 5,000. This will leave the remaining amount of the gains to be around 8,500. Now, 8,500 is the amount of the gain that we are left. And this should definitely compromise the deduction of annual exemption. This cannot happen. Capital loss should fully be deducted, but brought forward losses will have to be checked in if they are not wasting the annual exemption, which they are wasting. So not to waste, what should have to be done? You must have to write the annual exemption in advance this way, and then fill the gap, whatever you can, with the balancing figure in it. This is all the way the brought forward losses you have to relieve. So we are left out with 1500. Is it 1500? Let me double check. 22,000 minus 8,500 minus 12300. It's 1200. This is the maximum amount we could have possibly deducted, and we have. So to learn this brought forward loss, this question is the best one, Mr. B, that has made you all understood about that how to relieve the brought, first of all, how to carry it forward. And then when you carry it forward, you try to put a little bit of restriction over to it, only to save the annual exemption. How did I work? I have been able to write the capital gains of this year, current year capital losses, and then exemption, which comes next to brought forward loss. So, but I have been able to write them in advance so that I get to know the amount of the loss brought forward that I can possibly relieve after to it, which is 1200. Any amount of the loss that's still not been relieved, like out of 5,000, if 1200 has been relieved, 3800 has still not been, that will still be carried forward because it's indefinite number of years. Okay, so job is pretty much done. From the same page, we have been able to get ourselves okay with capital losses currently and brought forward, and also the annual exemption. And we have touched the bottom already. You may have not realized, we already have touched the bottom. This is a level now we are all standing ourselves at taxable gains. Now our gains have become ready to tax, and we are all set to tax them. That should be our next talk. Let's get into it. Capital gains tax rate. The next discussion. CGT liability computation. So it says £1 to 37700. The rate of tax is 10%. And when you go up to that mark, the rate becomes 20%, high rate. Also, noticeably, these are the normal rates of the capital gains tax. Normal. But what if we are dealing with a residential property? A house, an apartment, flat, cottage, villa, all of these are the residential properties. Then the rate of tax will be instead 10 or 20%. It will be still the same? No, it will be different. And easy to remember is that make the 10 look like 18, make the 20 look like 28. These are the rates of tax. But anyhow, the rates will still be provided to you in exam hall. But better to keep them in mind rather to look up into the Finance Act to really, naturally, by the time you will be preparing all of these topics and watching me explaining and again revising it at your side. So naturally, you will start remembering all of these rates into your mind. 1020 are the normal rates. 1828, specially applicable to residential properties. So if I have to understand how to make the use of, in my first example, the taxable gains are 15,000. So I just have to see to which band limit does it belong to. If it belongs to the first one, so the capital gains tax liability become 1,500. Okay with that. Applicable to case number 2, if the gains, they are slightly more than to the first band limit, Like the taxable gains now, I can assume it to be as 50,000. So definitely this figure belongs to a second band. So the rate of the second band is 20%, but it should not be applied flat. Up to 37700 mark, the rate of that will be 10%. Access will take 20%. It's 2460. By when the tax needs to be paid? So if I'm into tax year 22-23, tax year 22-23, the deadline to pay the tax by is 31st of Jan following the end of tax year, which means it has to be by this point of mark, 31st of Jan 2024. 31st of Jan 2024. If I'm into tax year 22-23, the tax year will start on 6th of April and will end on 5th of April. 31st of Jan following the end of tax year. Good with that. So all of that thing is written and you can have a look onto it. We can do the application number 5 then. See, 10%, 20% if the gains they fall into this limit, more than to that 20, but that will be 18 and 28 for the residential property. Everything at the end of the day is there into lecture notes. But you first of all come to see me explaining all of that to you. Then once you come back to read, you feel yourself so comfortable reading it. Even the date of payment is written 31st of Jan following the end of tax year, which means for this tax year, it has to be this. What is so extra written onto this page that you cannot really read or can understand? That takes us down to application number 5, which will sum up the whole pro forma from the top to the bottom, and also the liability computation for the first time. Let's do it quickly. All of that stuff is a revision based. We are doing it, but we're doing it smoothly, but still patiently everything I'm looking into and making it sure that you cover every little thing out of it. Mike sold an investment property on 1st of October 2022. Proceeds are given, acquired the villa building back in 2011 for this much and extended it at a cost of 20,000. Typically, we know how to compute those gains. Mike also had disposed of a painting, Feb 2023, 10,000 has been the proceeds balance. Auctioneer fee is 2%. He acquired the painting for 30,000. Capital losses brought forward are also provided. What is it? In the last line, they suggest Mike also has got a taxable income of this much in tax year 22-23. So what is this income of 15,000 is about? How to make the use of that, since we are taxing capital gains. And this is an income which does not have any relevance to the topic of capital gains. Since it's income, income is subject to income tax, not capital gains tax. So why is that being provided? What's the whole implication of it? We will see. At least let's go to prepare a pro forma, the same sort of a pro forma, which we also have done in one question above. In the same course, I can bring it out in front, this one. We can save a lot of time by copying and pasting this pro forma to solve the application 5, paste onto it. We'll have to come and change the dates of disposals, the title of those assets, and all those figures next to it. I can see one of the asset is a property, the second one is a painting. $700 has been the proceeds of disposal being acquired back in 2000. 400,000, and an extension cost on that is 20,000. There is no incidental cost of disposal and incidental cost of purchase. Mike also have disposed of a painting for 10,000, incurring an auction fee of 2%. He acquired the painting back in 30,000. And then the capital loss is being provided. So probably in the second column, we will have a loss because I can see the cost is quite a big figure in comparison to proceeds. This column will have a gain of 580,000. And this column will have a loss of 10,000 minus 30,000 minus 200. That's going to be around 20,822. So 10,000 minus 30,000 minus 200. That's 20200. 20200. This is 700 minus 100 minus 20. It's 580,000. So we've been able to work the figures. This is a negative one. And which tax year to which that disposal of painting belongs to. Very important to notice these. 1st of October, that property being disposed at 1st of October. Then the painting was disposed on the 1st of Feb 2023. And luckily, both they belong to the same tax year, I guess. Yeah, this definitely falls into this tax year. This definitely falls into this tax year. So both they belong to same tax year. So the loss that arrives in a current tax year we are in is called as the current year capital loss, and we have no way but to relieve it against the capital gains of the same tax year, which is what I can do it this way by writing it very next to current year capital loss. 20200. And then the capital loss, the brought forward. The brought forward loss this time is given as 19,000, and I can safely deduct without restricting since the gains are plenty to absorb the losses and exemptions altogether. So this time I do not need to be so safely. The exemptions, the losses have been, since the gains are plenty of and the losses are too small to handle, we have handled collectively. The figure after deducting the exemptions and the losses have turned out to be 528,500, and we are all set to tax them by the use of the gains and all, the band limits and all. Here you go. Okay. So which band does it fall into? It definitely it's falling into a second band, and we must have to tax the first 37700 at the 10% and excess at 20%. See, it's an investment property. It's not a residential property. Investment property is a business asset, not an asset within which you reside yourself in. It's not the house of yours where you live in with your family. Investment property is an asset that you invest in with the idea of letting that out, get rentals from. It's a business asset. So we're not going to apply 18% or 28% rate over to it. That is only applicable to residential property, a house. or a flat or an apartment in which you had been residing in with your family and all. So don't take yourself down to that 18-28% rate. Secondly, the question also has provided to all of us with this 15,000 of income. What do we have to do with that? See, these band limits are available once every tax year to each individual. So if I try to plot them in this manner, £0 to 37700, the rate of tax is 20%, let's say 10%, and goes up to that mark, the rate becomes 20%. So these band limits, getting back to the point, these band limits are available once in that tax year to that taxpayer, which means I will have to use the same band limits to tax my incomes and gains both from. And in the first preference, the income comes to exhaust the band limits. So if income that they have provided to all of us is 15,000, so let's try to plot it somewhere over here, that this much of the band limits have been used by the income of individual. Then what is left behind that can now be used for capital gains can be figured out by simply analyzing what portion of that is still not used that I now can use that for capital gains. It's going to be around 22700. Now, if I will wish to tax the capital gains, I will be able to tax the capital gains at the rate of 10% up to a maximum of this amount, while the rest of the limit is fully to be used, flat 20%. But within that first range, I only have got this much of limit, which can be taxed at 10%. So we are not learning itself how to calculate income tax right now. We are just understanding the implication of income, which will affect the liability computation of capital gains, which is what you people are all watching. So up to 22700 mark, maximum we can use this 10%, while the excess will take 20%. 5 to 8, 500. 5 to 8, 500 minus 505, 800. 1011 60, and that is 2270. That is it. So you also have now been able to understand in a very basic scenario how to compute the capital gains tax, and that is this way. If the question does not provide any income, or the question says that it does not have any taxable income, then all of those limits will be used for capital gains. But in that case, it could have not been. Excess will be taxed at 20. And the way I have found an excess, you can see as a balancing figure. The due date of that will be the same as above, since we are into tax year 22-23. So it will be 31st of Jan following the end of tax year, which is 2024. Smoothly moving it on, completing it, everything, not leaving anything aside. Death year capital loss. In relation to capital loss, a little discussion. Death year capital loss, as the name suggests, death year. So the capital loss that arrives in a year in which an individual has died is called as death year capital loss. So how to relieve it? Don't think of carrying it forward, because the life of that person has ended and there is no future of that person. So you cannot think of carrying it forward the way the normal capital losses are carried forward, the brought forward losses. It means when you cannot carry it forward, then you have the chance of carrying it back. Definitely, yes. So death year capital loss is rather carried back to last 3 tax years on a last in first out basis. And using the same technique of that to the extent that it should not be wasting the annual exemption. And you know this, not wasting the annual exemption by now. So death year capital loss sorry. Yeah, it's a death year. Probably someone has noticed the spelling mistake. I was also wondering. I just have realized sometimes, but most of the times, while you type in the notes, the applications like Microsoft word processor, they auto correct it. So I guess in auto correction, it has become dear has to be death, DEA, and then instead of TH, auto corrected to R. Anyways, on the screen, it's being corrected. Later on, I will be able to also update that into my side. So coming back to where I was, the death year capital loss cannot be carried forward because the person has died today. So that person possibly cannot have any capital gains in those next years to come. Could have only been carried back. How many years? 3 last years. Last in first out means the recent tax year will take the loss, and then second recent, and then third recent. Same logic should be considered that we are not wasting the annual exemption of that tax year in which the losses are being relieved. Let's come to apply that into application 6 to just see the way how will it be relieved. So the basic rule is carry back to previous 3 tax years on the last in first out basis. And to the extent that it should not be wasting the annual exemption. Application 6, Vanessa died on 21st of July 2022. And on 1st of June, she made a gain of 9,200. And on 19th of June, she had made a loss of this much. So she has both the gains and losses. In which tax year? Let's not forget 22-23. And even the loss is in the same tax year. Even she died in the same tax year. So the tax year of death is 22-23, within which she has been disposing before she had died some assets. And she has realized the gains out of some and the losses out of some. And then they're providing us with the data of previous tax years, and you can understand the reason why, so that we can possibly carry the loss back. To 21-22, the gains are provided. 2021, the gains are provided. Taxable incomes are also provided. Calculate the tax relief in respect of the capital loss in the tax year of death. So better we go and organize a columnar approach where I can write down all the columns 2021, 21-22, and 22-23. Application 6 is what we are attempting. So the chronological order, the 21-20 tax year will come first, and then comes the 21-22, and then 22-23. We can write down those gains and the losses. We have the capital gains in the 2021 tax year is 13100. In 21-22, it's about 17700. And then in this tax year, it's about 9200 is a figure of gain. And then we have a loss. So I can write it, the loss amount up there. Capital loss we have also. In the same tax year, we have a capital loss of 17,000. Okay. And this is not just the tax year, it's also a death tax year of her. So let's not just consider it's any other tax year, it's the death tax year. So the loss that has arrived in a death tax year has a special way to relieve, and that special relief is what we are in understanding of. So let's go to relieve it. This loss will be carried back to last 3 tax years, and the sequence of relieving the loss will be this sequence, not that sequence, because it's last in first out basis. Last in first out basis means this tax year will take the loss first, then this tax year, and if we had another one, we would have possibly carried it back, but we only have been provided with the data of previous 2 tax years only. This is the current tax year. This can use the same normal as if you relieve the current year capital loss against the capital gains of the same tax year. So you still be doing that. But carrying it back to last 3 tax years is the topic of the moment. So let's go to relieve it. Capital loss against the capital gains of the same tax year by the maximum that we are allowed to. It's normal thing. When you have a loss in one given tax year, you try to offset it with the gains of the same tax year by the maximum extent that you can. But then the death year capital loss will be relieved by carrying it back to last 3 tax years to the extent that they should not be affecting the annual exemption. So we can write the annual exemption in advance. You see, I'm using the same technique one more time. Using not to waste my exemption, I have been able to write them in advance. That should not be the case for the current tax year, because current tax year, by relieving the current year loss, you still can waste it, not a big deal. But while carrying it back and relieving the loss against the last 3 tax years, we should have to respect the annual exemption. Similarly, when you carry the loss forward and relieve it against the next tax year's capital gains, there you respect. For relieving the current year capital loss against the capital gains of the current year, we always have seen it that we may have wasted the exemption or we may have saved it. We do not really bother to look into. So the question provides us with the data of 3 tax years. But don't get me wrong. When the losses are carried back, we can go back to last 3 tax years. And right now we've been provided with the data of last 2 tax years only. This is the lost tax year itself, against which we have just used a normal everyday relief, relieving the current year capital loss against the capital gains of the same tax year. That's not the topic of the moment. Topic of the moment is to carry it back to the last 3 tax years, which right now we only can do it to the last 2, since the third last tax year, they haven't provided. And there we also have to respect this not wasting the annual exemption thing, as we also do while we carry the loss forward. And that is a way to do it. Now we can just fix in the balancing figure in between. And what is that? That is about 5,400. And that is about 800 only. Check this out. Now they want us to answer the tax relief that they will end up getting by carrying the loss back. So I go and work that tax relief one by one from this tax year. What is the tax relief? Or in other words, you can say, what is the tax that they have saved? See, the gains have become reduced by 800. So they will be saving a tax by multiplying the rate of tax with the amount of the gains. Those have been reduced by the effect of what rate does he pay tax? For this reason, we will have to look into the level of income this person has. She has gains of this much, and she has the taxable income of this much. So if I try to assess the type of taxpayer she is, I must have to give the first portion of the bands to the income of her, which concludes that the first band limit is still available. This much of the band limit is not used and can be now used for the capital gains. And the first limit of capital gains are taxed at 10%. So she is a basic taxpayer and she will end up saving 10% tax rate. Ultimately, the saving of tax from that tax year is going to be 80 pound. Because by this way, by this amount, the gains have been reduced and will save this much of tax rate, which means the total effective saving of tax from that tax year by relieving the loss will be 80 pound. Let's repeat the same story for the 21-22 tax year. Let's go to determine at what rate does she pay tax in that tax year. For this reason, I will have to repeat that story. We'll have to check the level of income that lady has. And to all of our surprise, she has this much of income, which means the first band limit has fully been exhausted by the income of her, and nothing is left that she cannot possibly use to tax her gains at 10%. She has become a high taxpayer, high rate taxpayer. So whatever the amount by which the capital gains are being reduced by, she will end up saving a tax at the highest rate, which is 20%. So this is where the whole thing has been concluded. Okay, keep it up. No problem. So what I have done in the past 15 minutes to tell you, this is from advanced taxation. This way, on the way, little aspects will be the part of our explanations that even if I will not tell you about, you will still be feeling it like as if we are revising the basics. This little thing, but to cover it, to learn this little thing, you have to have the detailed knowledge of current year, brought forward, capital losses with you in advance, which you definitely have. And then you have been able to top yourself with a little new thing in death year capital loss treatment. This is how the way the whole course of advanced taxation will go, where 100% you will cover the level 2 taxation subject. And with that, new things are attached to it, like a plugin. Sometimes you install a plugin into your main software. So main software still remains to be there, and you keep on adding more plugins to it. So this death year capital loss is like a plugin being attached to the main topic of current year and brought forward loss. That being an advanced taxation student, you must have to have the knowledge of current year capital loss in the first place, brought forward capital loss in the second place, and then that another plugin, death year capital loss in the third place. Cannot bypass the basic explanation of current year and the Bradford losses, you must have to have that thing with you before being able to top yourself up with death year capital loss. Fine with that. So a loss that has arrived in a tax year of the death is called as death year capital loss, needs to be relieved against the capital gains of last 3 tax years on last in first start basis, to the extent that it should not waste the annual exemption of those 3 last tax years. And this is what in that case I have been able to demonstrate. This is a current year capital loss being relieved against the capital gains of the current year. So never mind, even if you lose the exemption based on to it, normally a case. But when the losses were carried back, we still have adopted that approach of writing the exemption in advance and taking those balances to be the balancing figures in between. And then how we have ended up finding the savings of the tax, it's all there in front. Assessed the rate at which the lady pays tax in that tax year at and in this tax year, and according to that, definitely she will end up saving a tax. Okay with this? No problem. Part disposals, we are heading towards a very little explanation. We are getting into a topic which is called as part disposal. As the name suggests, part disposals. An asset has been disposed in a part and usually applicable to property, precisely to a land, because land is kind of an asset which is disposable in part. You cannot dispose the machinery in part. Taking an example of the laptop, and you dispose the laptop in a part, your mind will not even accept. Selling an aircon in a part. So land, you probably have 10,000 square meters of land, and then you decide to dispose 2,000 square meters of it out of it. So possibility of disposing an asset is associated to the property. At times the building are also the one story of that building has been disposed. So disposing the one story out of that whole complex will be a part disposal then. So usually the property. What is the main thing that we are interested in understanding it in is the formula to compute the cost of portion being disposed. Because when that land was acquired, you know the cost of entire land. And when you are selling the part of it, you need to find the portion of cost of the portion that has been disposed. And to find that out, you need to have that formula. Very simple, easy formula, A over A plus B, where A equals to the market value of the part being disposed and the market value of the remainder portion. Suppose 50 acres of the land, that's what you actually own, and have disposed 10 acres out of it. So this A will be the market value of the part being disposed, and B will be the market value of the remainder portion. The remainder portion will be 40 acres, and these values will be provided. Just have to make the use of that into that formula to get our answer done. The main thing in the topic of part disposal is to find the cost of part being disposed, because we know the cost of the entire land, but we need to break a portion of cost so that we can associate that with the part being disposed and match it up with the proceeds to calculate the gain or maybe a loss at it, which is what we come to achieve in a very simple, easy way. And that way is the formula. A divided by A plus B. A equals to the market value of the part being disposed. B equals to the market value of the remainder portion, and all in a nice manner in your lecture notes being written. We've got application 7 to apply this little explanation at, and then we will have something further to look in, which is called as small part disposal, which is going to be from the course of advanced taxation. This explanation is from the basic course of tax. But the small part disposal, remember, I used to say a plugin. Another plugin will be added in, will be installed in. So to understand that small part disposal thing, you must have to be okay with a normal case of part disposal. So let's go to apply this normal case of part disposal before we can top this up with this small part disposal even. Cyrus bought 7 canals of land in total back in 2012 for this much. 2 out of 7, if disposed, definitely a part disposal or not? Because not the 7 acres being disposed in a one go. 2 out of it definitely is a part disposal. For 11,000. At the time, the remaining land was worth 72. Remaining means 5 acres. According to the scenario, it will be 5 acres. In June 23, Cyrus then sold the remaining 5 for 110. So eventually 7 acres have been disposed, but in 2 parts, not in a one go. So they want us to calculate the capital gain. And I will, without considering to apply this small part disposal, let's produce the solution for application number 7. By making not an election, we are producing. Not making an election means it's a normal case. When you will make an election, we will then see this small part disposal thing into. So normal case means when an election is not made. And what is that election and what happens once an election is made? You will come to soon learn it in a while. So we are solving the first part. Second part right now, that is about election is not made, which is a normal case. Where election is made is a small part disposal. Okay, so first of all, there has been a disposal of 2 acres. Checking the date of the disposal very formally. It's not acres, it's canals. September 2022, let's write it, September 2022, this has been the day of disposal. Proceeds, I have to come and write for 11,000. And then we'll come to subtract the cost. The total cost of the 7 canals of the land is given as 35,000. And A equals to the market value of the part being disposed divided by the market value of the part being disposed plus the market value of the remainder portion. So the market value of the part being disposed is 11,000, because that will be the same as the balance of proceeds, because on the day if you sell 2 canals for 11,000, that will even be considered to be the market value of 2 canals. Is it? That will also come in the bottom, 11,000. Plus the market value of the remainder portion on that day was 72,000. That is B. So that's how the way that this formula has to work. You know that formula, you can apply it probably by taking a minute or even less than a minute to get your answer done. 11 divided by 83 multiplied by 35,000, it's going to be 4639. So 4639 minus 11,000, the figure turns out to be 6361. And then 7 canals of the land has even been disposed. Later on, the day of that disposal was June 2023. For the proceeds of 110,000, what should be the cost of the 5 canals of land? Mathematics. If out of 7 canals, the 2 canals have taken this much of cost, the remaining, the 5 canals will take. The total cost is 11,000, no, 35,000. So if out of 35,000, we have been able to give this much to 2 canals, the remainder should give it to 5 canals. Simple as that. 35,000 minus 4639 is going to be 30361. So 30361 minus 110,000, it's 79639. 79639. Okay with that. So this is when the election is not made. You come to calculate the gain on the disposal of a part, and the formula is A over A plus B. And then once you're done, you come to deal it with the remainder portion whenever it has been sold. How to calculate the cost of the remainder portion? Take the total cost, subtract what you already have assigned, and find the remainder to be used over here. This is part disposal. When an election is not made. But now we are heading towards to a scenario where there's going to be an election. So to become qualified to use an election means election cannot be made like that. First of all, we will have to satisfy the set of conditions. Then after the conditions are satisfied, they may not be making an election, or they may be election. So election can only be made provided those conditions are satisfied in the first place. So we must have to first look into those 2 conditions before becoming eligible to apply for that election. And the first condition says that your disposal will be classified as small part disposal only and only when the 2 of those conditions are satisfied together. The word "and" has been used in between. The first one, it says that the proceeds of the part disposal has to be less than or equal to 20% of the market value of the land before disposal. So proceeds of the part disposal in that case is this. I will come to check this. If it is less than or equal to 20% of the market value of the land. In my second, the proceeds from the sale of all the land in same tax year has to be less than equals to 20,000. So this 20,000 is not an example. You have to remember it because that's a rule of law. 20,000, the limit that you have to consider. If you cannot remember these 2 conditions in the live course right now, not a worry, just put them up onto a screen and apply it with me. Later, when you will revise, you will be having enough of a time to remember it. As number of times you will read, you will start remembering. So let's go to apply it. In the first place, to see are we being eligible to elect, and then we may not even elect afterwards. That will be our choice then. The first condition is that the condition 1 and condition number 2, and both need to be satisfied, like I said, together. The condition one, it says the proceeds from the part disposal, which is 11,000, has to be less than or equal to 20% of the market value of the land. So let's go to find the 20% of the market value of the land. What is the market value of the land? So if you look into that question watchfully, market value of the total land before disposal. He sold 2 canals of land for 11,000. It means that must have been the market value of 2 canals. And then on that day, the remaining land was worth 72,000. So that is a market value of remainder. So by taking the market value of part disposed, market value of the remainder, the total market value has to be 83,000. Which you can remember it in that way of A plus B. Remember A plus B, the denominator, market value of the part being disposed plus the market value of the remainder portion. In fact, this is the market value of total land. That you can remember it always like A plus B. I have to take it to take a 20% off. Okay. What this figure will produce, we will be able to check if it is less than to that amount or not, which is 16600. So the first condition is satisfied, as the proceeds from the part disposal of the land is less than to the 20% of the market value of the total land. What is the second condition? The second condition takes 20,000 fixed. So I just can write it. I do not need to calculate anything. Just need to calculate this. The proceeds from the sale of land in same tax year. So they have disposed the land in 2 parts. So I have to see if both the parts they have disposed in same tax year or in either of the 2. This looks to me have disposed in tax year 22-23. But that is not the case with this one. That's another tax year. Yeah, imagine if they have disposed both the parts of the land in the same tax year, I would have added the proceeds of both. But right now it's not happening. So we will end up taking only the proceeds of this one then, because in one tax year, this part only has been disposed, which is the 11,000. And this condition is also not been satisfied. So once the 2 of those conditions are satisfied, now we are eligible to make an election. We may not still make, but we are at least eligible to make that election. So what is that election? Once an election is made, the gain will on the disposal of the part will not be worked. Means we will not do this computation. On the day a part is disposed, we will not do anything like this. The gain on the disposal of a part will not be computed. What instead will be done? See, what instead will be done if an election is made? Election is made. So on the disposal of 2 canals of the land, the gain will not be worked. What has happened? Yeah, fine. Two canals of the land being disposed. And the gain on the disposal will not be worked. Instead, what will be done? From the cost of the total asset, proceeds of the disposal will be deducted to find the revised cost. That's going to be 24,000. This is a cost. This is a cost. And we've been able to subtract the proceeds of the part disposal out of it to find the revised cost. Now, this revised cost will be used tomorrow when the asset will be disposed, the part will be disposed later on. And that is happening when the five canals of the land were disposed later on. So I will be able to use that revised cost to compute the gains based onto it. Should be on the next page. So the cost that I am going to use is the one that I have been able to revise, which is 24,000. So when election is made, gain on the part disposal will not be worked. Cost of an asset will rather be revised, so that tomorrow, when the second part of the asset will be disposed, the same revised cost we will be able to use to calculate the gains in. Because by revising the cost has been understated. And the amount of understated cost you will deduct, the more the gains you will end up assessing. But this has at least given that taxpayer a relief of not paying the tax when the first part was disposed by making an election. See, normally what happens? On the day a part is disposed, immediately the gain becomes assessable and he or she ends up paying tax on. But when an election is made, the gains on the part being disposed have not been assessed. Rather, the cost of an asset has been revised by the amount of the proceeds. These revised costs will then be used tomorrow when the other part will be disposed. For the sake of computing the gain, we will use the same revised cost. And once the cost has been revised, it has been reduced. And the more the amount of the cost that you have deducted it from, the more the gain by that will be assessed extra. So you must have to understand this one extra plugin, which has been attached to the normal A over A plus B discussion. To be eligible to apply for this election, these conditions on the way must have to be checked. Provided the conditions are satisfied, then we are eligible to elect, but we still may not elect. But because they had wanted us to make an election and produce the solution on the basis of, so I can make a title of this one as election not made, because applicable to the given facts, he is eligible to make an election. So we have been able to produce a solution within which the first one says that the election is not made, although he was eligible to make that election, but he has not made, and he has performed whatever we normally perform in a part disposal question. But when he has made the election, you can really see the difference of me not computing the capital gain, rather revising the cost of that asset by deducting the proceeds out of the cost, so that tomorrow, when the remaining part of that asset will be disposed, that revised cost will be used to compute the gain only then. Whereas normally, there is a gain calculation on the day the asset is disposed by using that A over A plus B formula. And then the remaining cost, we come to use it when the remainder part is disposed. Coming back to the conditions, the first condition is the proceeds from the part disposal has to be less than or equal to the 20% of the market value of the land. And the market value of the land is in fact the A plus B. And the second one is that the proceeds from the total sale of land in same tax year has to be less than or equal to that 20,000 pound, which in that case was not in the same tax year. So I only have taken then 11,000. Otherwise, if both disposals have taken place in the same tax year, I would have added the proceeds of this one into this to check this condition with. Such a nice way it's written over that you must have to come and visit to remember it. Because at the end of the day, after you have taken the course, I've given all of my energies to explain that to you off. But ultimately at the end of the day, to keep that into your mind is your own job. You keep it, you're successful, and you're not keeping it, you will lose marks. To make an election, there is a certain deadline that one has to respect. And the deadline is 31st of Jan, within 1 year. So suppose if I'm into tax year 22-23, which starts on 6th of April 2022 and ends on 5th of April 2023, the election is to be made by 31st of Jan following the end of tax year, should be by this. The gap has to be of 2 years. So if it is 23, that has to be 25. Within 1 year of 31st of Jan, following the end of tax year, which will be 31st of Jan 2025. It's written over here. Within 1 year of 31st, following the end of the tax year of disposal. So for the tax year 20, supposed to be 22, 23, it has to be 25. Okay with that? So all what is there on this page, nicely I have been able to talk about. There's hardly anything that you see on the up that I have not commented. And this has been the case for all of those pages, the last we have spent the time on since the start of the course. Everything's coming to our way, we're finishing it off, So case is very simple. When an asset is disposed in a part, the first thing that you have to come and apply the conditions, because these conditions will let you know that if you are eligible to make an election or not eligible. So if you are not eligible, you just go and do this. And if you are eligible, you still may not make an election and do this. Or if you are eligible and make the election, then you do this, deducting the proceeds from the cost to calculate the revised cost. 3 possibilities, and all nicely have been talked about. Solution from all the sides, I have been able to explain that. What in that situation we have to do? What in that situation? So this way, little on the way, things will keep on adding. If I was conducting the same topic for my level 2 students, I would have stopped myself only over here. But you people have been added with this one more extra plugin, that you as an advanced taxation student needs to have the knowledge of this one also and that one also. The level 2 student will only have a knowledge of this. So 2 of the examples that now you have seen me working gives you the idea of that, how the way the lecture notes are written. A lot of advanced aspects are embedded, blended with your basic aspects, that on the way to learn those basics, they will be topped up on the way like this. That specifically, if I do not title them out, you may not even realize it if it is a new topic to you or not. Remember, we have talked a little about this connected party thing up there. Now we can come to look into it a little more in depth. Connected party. This is a chart of to whom I'm in connection with. Being a taxpayer, to whom am I in connection with? Remember that discussion when an asset is sold out to a connected party, market value instead of proceeds are used to compute the gain. That's the same thing on the top being written. Market value is used as consideration to compute the gain loss. You know that. And you know the whole reasoning of that behind that, why we are asked to use the market value instead of proceeds to compute the gain and loss. And that reasoning was that whenever the assets are sold up to connected parties, they are usually sold at the price less than to market. Here we are formally coming to look at it, to whom I'm in connection to, family-wise and my profession-wise. Because also in regards to my profession, some of the parties can be in connection with, means the partners that I'm into my partnership business, or if I'm a shareholder of a company, then might be the other shareholders of that company. In my family, obviously, a spouse should be the most important, close, connected party to a taxpayer, husband to wife, wife to husband. And then you come and look onto the left-hand side, the siblings and their spouses, the parents and their grandparents, children, the grandchildren, and then the spouses, siblings and all. So this chart shows to all of you to whom the taxable person will be in connection to, but more commonly, the connected parties you will come across to into your exam attempts will be the ones that you will never be having a doubts over to, like sister, brother, daughter, father, son, wife, so close to you that you will never be having a doubt in your mind, is it a connected party to me or not? Third cousin, fourth cousin, like this way. You will never be confused on this, that now you'll be having a question mark. Should I call the third cousin to be my connection? Fourth cousin, fifth cousin, uncle, aunt. Usually it will be brother, sister, daughter, father, son, wife. Easy for you to say that, yeah, this is connected party. As far as the business relationships are concerned, so if I am a partner of one of the partnership business, so the other partners to me will be the connection. Even the relatives of that partner will be the connection, means the spouses of that partner, relatives of the partner. That's all written there. I can reveal it. So if I run a partnership business with some other partners, so the partners of that partnership businesses are in connection to me, even the spouse of that partner and the relatives. And if I own the company within which I have a shareholding, so the other shareholders of that company are in connection to me. Person of the company that they jointly control, which means the shareholders. Would be that. So these are the business relationships. Shareholders of the company that I am a shareholder in, they will be in connection to me. Partners of the partnership business in which I am itself a partner, and then the relatives of that partner, the spouses. And that is in regard to family relationships. So these two charts were there to have a look at it, and we've been able to. Okay. And the rule that you should not be forgetting to apply is to make the use of the market value instead of proceeds for the purpose of computing the gain or maybe a loss. Any loss that you may have arrived on the sale to a connected party. Suppose you have made the sale of an asset to a sister and you have made the capital loss. Since the market value was less than to the cost of an asset, can happen or not. Asset has been sold up to a brother, and brother, because is a connected party, so you have been able to use the market value as the proceeds minus the cost, and now the figure has turned out to be a negative one. But what do we call it as? Capital loss. So this capital loss has arrived due to the sale being made to a connected party. So we are supposed to offset that loss against the current or future gains from the disposals to a same connected person. Very important. So tomorrow, if I will sell off another asset to the brothers, against the gains of that sale, I will be able to possibly offset my loss against. This is special because we do not apply this rule to unconnected parties, because in unconnected party, if I have a capital loss, I just can move it around anywhere else with any other disposals. But in connection, same connection will be used to offset the loss against. Today, I make a loss out of the sale being made to a brother. Tomorrow, if I make a gain, I will use that loss to offset it against the gain that I have made out of the disposal of an asset to a same connected party. Nothing is there more to learn except these charts to be viewed within the live session and even off the class, which is what we at least have done it in the live session. The time has come up that we go and take a break for 15 minutes. Lot many things are still planned in the next almost 1.5 hours of the course being left. After the break, when we will resume, we will be having around 1.5 hours to continue. Stay tuned, stay active, stay committed. Don't go anywhere. I will see you in about 15 next minutes to resume the course. Okay, I'm back. Hoping you're also there with me in the continuation of the course of today. So starting off with the next topic, transfer in between the spouses or civil partners. So considering a case where husband is making a transfer of an asset to his wife, and we are here to calculate the gain on the disposal of this. It has been disposed for 17,000, and actually the gain that has been assessed on his side is 7,000. The wife has paid 70,000 to acquire, the husband has received 17,000 to sell. But inter-spouse transfers are always at no gain and no loss. Whatever actually has been achieved, this will be deemed to have no gain, no loss. So to have no gain or no loss here, what balance of proceeds should I be assuming? Same as cost. So 10 minus 10 equals to 0, which will be an assumption for a wife as if she has paid 10,000 to acquire. And tomorrow when she sells it off to someone else for whatever the price, the cost that she will end up using is the one now her records suggesting 10,000. Okay with that? So what sort of benefits that and get out of it? They with that interspouse transfers, the process of achieving the no gain loss transfer I have explained. Now we can talk about the benefits that they can enjoy. They can get out of this no gain no loss transfers. Broadly speaking, if I have to talk about, they can plan the tax by the way of making the transfers of assets to each of them. Since when they make a transfer to each, they do not pay any tax. In a case like when husband is a high taxpayer and the wife is a basic taxpayer, the husband can simply hand over his asset to his wife so that when she would sell, the same disposal will become taxable at the basic rate of tax. If he had himself sold an asset to someone else, he would have paid high rate of tax onto it. So that can be one of an incentive they can get by making the transfer of assets to each of, depending it upon out of the two, which one is the basic taxpayer and which one of them is the high taxpayer. There's also a chance that occasionally they can double the annual exemption, because by involving a spouse and asking the spouse to sell an asset will have an incentive of having another annual exemption, since two individuals then will be involved. Rather, husband sells off an asset to someone else directly, sells it to his wife first, so that the wife will sell the same asset to the person he was wanting to sell. And this way, by involving the wife, spouse, they can have a chance of getting the two annual exemptions. Also, at times, it can happen one of the spouse may have a capital loss, but may not have any capital gains to relieve the losses. So another spouse can help by making a transfer of asset to that spouse, so that then that spouse will sell off that asset to someone else to get a gain against which the losses can simply be relieved against. Now, these are all incentives that casually, broadly, I have been able to suggest, but we have got questions which really can quantify this whole thing happening. And you'll be able to see it's a very small little expression. As you can see, there's not much of a length there, followed by application 8 only. So let's take that application 8 and we'll see what sort of incentive they will get out of this whole inter-spouse transfers. You wish to read, you can. Inter-spouse transfers are always deemed to be at no gain, no loss. Which means whatever they have done actually, that will be ignored. Deemed, like in my example, the actual scenario was 17,000 minus 10,000 equals to 7,000. This was actual, but then I have been able to deem it to be as no gain, no loss. Actual disposal proceeds are ignored, as I have ignored. The transfer is deemed to dispose of an asset at its acquisition cost. Can't you see? The transferor, which is husband right now, deemed to dispose of its asset at its acquisition cost. I mean, the disposal proceeds has been assumed to be the cost of acquiring an asset itself, which will in itself be the cost of acquiring an asset by the wife on a deemed basis. So in wordings, this is how the way this thing has been explained. But if you already have got this thing that has been explained to you, you are done with that. No need to come and really look into this. The rules will only be applied if obviously the spouse, they're living together. They're not divorced, they're not separated. Obviously, they are still being called as husband and wife. It's pretty obvious. The Graham and Jennifer. Graham acquired the house for £15,000 on the 14th of May 2004. Back in 2004. He sold his house to his wife Jennifer for £30,000, and the market value of that was 35,000. Jennifer then making the sale of that house to someone else. She has a brought forward loss of 5,000. The Graham has a taxable income of 45,000 in the tax year 22-23. So we'll have to start off the first party first, and the Graham seems to me owning that house in the first place. Yeah. It's the Graham who has been owning this house. So I'll start off with that party first, application number 8. And there comes his lady, Jennifer. And there has been the sale of a house in between. For how much? This has been sold out for 35,000, no, 30,000. The cost of buying an asset previously was 15,000. One of the vital piece of information is the cost of acquiring, because this then will become the basis to make an assumption. Need to watch it nicely. For how much it has actually been sold out for? Actually 30,000. And this is the gain that we have ended up assessing. And this is what the price that she has actually paid. Since these two are the spouses of the married couple, husband and wife, no gain, no loss. Proceeds will be an assumption, same as the cost, which will even be an assumption for the Jennifer as the cost of buying an asset. Then she comes to sell this off to someone else later on. The day of the sale to someone else later on was 1st of March 2023 for whatever the price that it has been sold out for, 45,000. The same cost that she would end up using, 15,000, to calculate her gains. Now, again, what sort of benefit are they getting out of this entire? Why did he sell his house to her in the first place? Both they live in the same house. Both they are the spouses of the married couple. So he owns the house or she owns the house. Ultimately, both as a couple, they jointly will get risk and rewards of that house with them, because they're a couple living together under the same roof. So why did he sell his property to her, and then she does not even hold that on her side and coming to sell it to someone else? So he could have sold that directly to someone else. Why he has involved his partner in his whole sale transaction of house to someone? He could have sold this house directly to someone else directly, but he has not. He rather has sold it up to his wife first, and then instructing his wife to sell it up to someone else. Why has that been the case? Because of this reason. I told you, she has a loss, and this loss could have just been a waste if she does not have any gains, because she does not have any property on her name. So she cannot have any gains ever to relieve these losses against. The only way that these losses can be relieved is by having a disposal on her own. And actually, she does not own any property, any car, any house, any building, any business, any. So the husband has helped her in selling his house to her, so that once the house has become her ownership and she sells it up to someone else later on, the gains will be assessed in her pocket then, and she'll be able to relieve her losses out of those gains to benefit the both. Ultimately, both they will enjoy the feast, because gains will be reduced by 5,000. And ultimately, whatever the saving of tax, she will be entitled to legally, but ultimately, both of them, they will enjoy it as they are a couple. Otherwise, this 5,000 would have just been a waste. Loss will be wasted. Gains will not even be reduced. You could have done that out by planning it out in that way. So that's the only possible incentive that they had it in this, to make a transfer of house to Jennifer. So let me first of all complete the whole solution of it, then come to talk about that further. Capital loss simply been relieved, 25,000. The gain, see, the gains have been reduced by 5,000. And ultimately, the lower the gains that she will have, she will end up saving tax. And ultimately, that saving of tax will benefit the both as a couple. If imagine he had sold this asset to someone else directly, the gains of this much would have been assessed on his side. Her loss would have been a waste. Fine. Okay. Another benefit that what I'm viewing it that you may have not been, Graham is a high taxpayer. Check the level of income he has. Graham is a high taxpayer. Check the level of income he has. This 45,000 comes to exhaust the first basic rate band limit, which means any gain that will be assessed on Graham's side will be taxed at 20%. Whereas she does not have any income, and all of her band limit 37700 is untouched. Therefore, whatever the gains that will be assessed on her side will be taxed at what rate? Basic rate. That is another incentive of giving his house to her, knowing the fact that the spouse is a basic taxpayer. So if I can give my house to my spouse and asking my spouse to sell this off to that person that he was wanting to sell to, then she would liable to pay 10% rate of tax onto it. And this way, both as a couple, they will get the benefit out of it. Okay with that. This is what they had been wanting us to calculate the Graham and Jennifer capital gains tax payable. So obviously for this side, the CGT liability will be 0, as no gains have been assessed on his side. For this side, we can work the gain by deducting that annual exemption, like always we have done, to make these gains taxable. Never mind, we will be able to, it's not a big deal. What the whole thing I had to explain, I have been able to at least convey. Okay with that? Two incentives. First, the relief of the capital loss was on the cards. Secondly, the basic rate and the high rate. The husband is a high tax rate taxpayer, while the wife is a basic taxpayer. So good planning to give his house to her, so that when she will sell this off to someone, she will end up paying basic rate of tax onto it, and she'll be able to relieve her losses on the way even, which will benefit the both as a whole, as a couple. Another benefit that one can get, I have said it, but it's not applicable in this case right now. The exemptions can be doubleized. To doubleize the exemption, there has to be two disposals. Means there has to be two assets being disposed to have two exemptions. On one asset, you cannot have two exemption. Either he will sell or she will sell. Ultimately, they will end up getting either of the exemption. Either of the two, they will get exemption, not both. For the exemptions to doubleize, there has to have two disposals, so that one party will dispose one, another party will dispose another one, and both then they will be able to get their respective annual exemptions. And the more of the exemption that they will have, ultimately they will end up saving a tax. So I can make one example roughly, quickly, to also cover it if still someone is confused at what I just have talked about. This is Mr. A, and Mr. A actually will be willing to sell two assets. Asset 1 to Mr. M. And he's wanting to sell an asset to Mr. N. But he rather has sold it out to his wife. The backhand story is that he is wanting to sell off this asset to Mr. N, but not this asset being sold for 40,000 to Mr. M, and to his wife, this has been sold out for 30,000. The cost of these assets are 27,000 on this side. It has to be 14,000. So the gain actually is assessed 16 onto that side, 13 onto this side. Because of that inter-spouse transfer, it has to be a no gain, no loss transfer. As a result of that, now this has become the property of wife. Now he instructs his wife to go and sell an asset to Mr. N that he was wanting to originally sell, and the wife will follow his instruction, because ultimately they will get the benefit out of that, both of them. Planning a tax this way can benefit the couple as a whole. So Mr. N, the asset is going towards, for the same proceeds of 30,000. The cost that she is going to use is the one that her records suggest, as if she has paid 14,000 to acquire. And the gain of 16,000 now has been assessed in her pocket. she will be happy to use her own exemption out of it to bring those gains down. On his side, he will be able to enjoy his own exemption. And this way, when overall the level of the gains will fall, they will end up saving a tax. You see, twice of the time. If he himself has sold these two assets by himself to two parties, he would have enjoyed only one exemption. But he has involved his wife with the intention of also getting that. So these are the benefits. And in about 20 odd minutes, I have been able to wrap up this one little talk on the way, and we're over to it. Okay with that. No claim, no election is required. It's automatic. Whenever the transfers are there in between spouses, they are by default at no gain and no loss. The process of that you will have seen, and what sort of benefits that they can get out of that, I even have been able to explain. Two of them itself in that application, losses and the rate of tax, and this exemption to double eyes in this case. Okay, convinced? Taking ourselves towards chattels and wasting assets. A very little discussion that should not take more than the next 30 odd minutes to finish, and we can quickly finish it off. Chattels and wasting assets. So the definition of chattel, anything that has got these two characteristics is called as chattel. Tangible it has to be, and movable it has to be. So any example that will have these two characteristics will be a chattel. Table is a chattel. Chair is a chattel. Land is not a chattel. Tangible but not movable. Building is not a chattel. Tangible but not movable. So you have to apply it. So anything is chattel that will have these two characteristics in. What makes an asset say wasting? The useful life of an asset has to be less than equals to 50 years to make it wasting. I mean, these are the things the student of advanced taxation has to be always on fingertips. Always on fingertips. Useful life less than equals to wasting. Okay, if it is more, then it's called as non-wasting, the other way around, non-wasting or not wasting. And this will divide this whole topic into many categories: wasting chattels, non-wasting chattels, other wasting assets. You see that we're categorizing this topic into three categories: non-wasting chattels, wasting chattels, and wasting assets. Those are not the chattels then. Third category is the one in which we do not have chattels, but we do have wasting assets. And these will usually take intangible assets like brands, copyright, royalties, patents, because they will be having a life of 5, 6, 7, 10 years maximum. But they're not chattels in kind because they're intangibles. Because we have different set of rules for each. So the whole thing has been categorized into three. Movable, tangible is chattel. Examples could take table, chair, painting, machinery. Machinery is chattel also, because machinery is not as fixed as the building is fixed. A machine can still be unfixed and you can move it away, like aircon is a machine. For a time being, it's fixed on the wall, but you can detach it and take it to another room. That cannot be the case with the building. So painting, machineries, jewelry, chair, tables, antiques are all what the chattels. They are not chattels, as I already have told you. Land, building, and shares are not chattels. Wasting assets, not more than 50-year life is called as wasting, but if the asset will have a life of more than 15, that should be called as non-wasting. Even you look into this category under below, the definition of that has been well revised because it's non-wasting. So the life is more than 50 mentioned. But because on the other side, it's chattel, so it's still taking the tangible and movable thing into it. And see, the examples are antiques, jewelries, paintings, pictures, because they definitely will be having a life for more than 50 years. Gems, gold, platinum, silver, and all sorts of ornaments, antiques, pictures, paintings. Wasting life less than equals to 50. And because it's still chattel, so tangible, movable is thing is attached. The examples could take machineries used in the business, a racehorse, the boats, because they don't have a life of more than 50 years, could have a life of 5 years, 10 years max. And this category will take not the chattels they are, but at least they are the wasting assets. Intangibles such as copyright, patent, royalties, and all. So let's start having a talk with our first category, with the non-wasting chattels. So under the banner of non-wasting chattels, there are a lot of examples, small examples I will go to put forward to explain. And then we will also have a go and look and back and see the way the things are written back into our lecture notes. That's the case one, where I can make further two cases down under, case A and case B. In the case one, what makes this example to say that it is an example of case one, first of all? When the proceeds and the cost, both they fall short of 6,000. See, it's less than to 6,000, proceeds and the cost both. And when this is the case, you are into case one. That's the definition of the case one. That's the definition of the case one. Okay, then you may have a gain, you may have a loss. Gains are not taxable, or in other words, exempt. Losses are not allowable. You people have remembered that discussion of losses we have had it today, currently brought forward. So we will not be relieving it. We will not be calling it as capital loss current year to relieve, because it's not allowable. Same way, this 1,000 will not be taxable. So gains are not taxable, losses are not allowable when you are into case one. And what is the definition of case one? Both the figures will have to be less than to that 6,000 mark. Both. Oh, it can be equal, by the way, but at least it cannot be more than 6,000. Both the figures will have to be less than to 6,000 or can be equal to. Means either of the two is equal and other one is less. You have a gain, you have a loss. Neither of the two will be accepted. It means zero, it means even zero. That's the case one. See the way it's being written back into our lecture notes. Bought and sold for less than or equals to 6,000. That's the first case. And what do you see down under? Exempt. No tax consequences, whether you have a gain or you have a loss. So nicely to the point it's written, and you also have got the whole clarification of that. Let's take ourselves to the case two then. In case two, a lot of possibilities I have to put forward. Be watchful. A lot of possibilities, so I can rather make 4 columns: A, B, C, D. One has to have a bit of a space in between. Okay, so over here we have proceeds to write, and then we have cost to write. So I will have to make 4 possibilities down under. So the proforma has all been prepared. Now you can start fixing the lots of. This should be the opposite of what we have done. Exact opposite of that means that the proceeds and the cost both are more than to 6,000 pounds. You can't, you can see the proceeds and the cost, both they are more than to that. That's exact the opposite of. So let's just work the answers, and then in the end, we will conclude if it is taxable or not. Both the figures are still more than to 6,000 mark. Now we have a loss. So same case, both the figures are more than to 6,000, but here we have a loss. What to do? Have patience. Another possibility under the banner of this case that I can have, that one of the figure is more, the other one is less. This is 9,000, but let's make this amount less than to 6,000. This is another possibility. Means one of the figure is more than to 6,000, the other one is less. Still the case number 2. And similarly, this figure is 4,000, less than to 6,000, and the other one I can have more than to 6, and we have a loss. This, first of all, is case 2. Case 2 is when either of the two figures are more than to 6,000. No, not either of the two, I would say. Both of them will be more than to 6,000, or either of the two. There, the either of the two is applicable. And when both are less, it's case 1. Little topic this is, but because of lots of possibilities, the students at times they start confusing. First case, where both the figures are less than. Second case, both the figures are more than to 6,000, or either of the two is more. So we have a loss in this situation. What do we have to do? Gains will be taxable normally. So the gains will be taxable normally. Means the way that we normally tax the gains, this will even be taxable. And losses will even be allowable normally, nothing special. You may have thought that something special is coming to your way. So I have written it, taxable normally. Allowable normally. Normally means the way that you relieve the losses, current year capital losses. Taxable normally be the way that normally you tax the capital gains. That's what's being written over here. Check this out. Gains or losses, whatever you have, normal way, you must have to treat them taxable. Either of the two, more or less, or maybe both are more. That's the second case. And nicely finished. Now we can do 9th, 10th, 11th application to formally quantify this. That much of a talk is enough on the first category of chattels and wasting assets. Which application is that? Application number 9. Jack bought a painting in March 14 for £10,000. He sold the painting for this much. He incurred an auctioneer fee of 500. They want me to calculate the capital gain. So I can first of all write the pro forma, which will make me to determine the case that I have been tested on. Proceeds on the disposal are 13500. Well, the cost of acquisition is 10,000. Now I can find one of the figure is more than to that 6,000. Or even the both of them are more than to 6,000. So it's the case number 2, and within which we come to assess the gains as normal. So the gains will be taxed as normal. Yeah. Then comes the application number 10, and I can try to save a bit of a time by copying and pasting the pro forma. Application number 10. Okay. Melissa bought in two antique chairs in June 9 for this much, and they sold them both for this much respectively. So there are two chairs, so we should rub this. And I can make the room for two chairs, chair one. And there comes the chair two. The proceeds in the one case is 7,900 and one for $1 respectively, one for 100. The cost is 2,500 for both. That figure is 5,400. 1 for 100 minus 2,500, that's about 11600. So which case are we interested in? Still the case number 2, because I can see one of the amount is more than 6,000. The other one is not more than 2. So the gains will then be assessed normally. And I just need to pool. I mean, even if we have not done these questions, you would have not found any issue, because I already have explained to all of you all the possibilities in my illustration up there. There's nothing special in these applications. We are getting it from. Application 11 should be the last one on this before we move to the next category. This is application number 11. So Ronald bought a picture in September 2015 for £8,000 after incurring an additional cost of £300. Ronald sold the picture on 19th of August 2022 for 3,000. He incurred an auction fee of 200. So we have incidental cost coming to our way for even the cost of acquisition. So I'll have to make the room for it even over here. The incidental cost in relation to the sale is 200. And in relation to the acquisition, it's 300. The cost of acquisition is 8,000. While the proceeds of the disposal are 3,000. So looking to all of us, we are making a loss out of it. But key thing to notice is that this one of the figure is falling short of 6,000. The other one is more than 2. So still into a case 2, and whatever the loss that we will get will be accepted as it is. 3,000 minus 200 minus 8,000 minus 500 minus 300. It's going to be 5,500. A loss, not a gain, which is what we call it as capital loss current year. And we will be relieving it the way that normally the current year capital losses are relieved, and we know that how. Quickly making it show that we are touching everything, but not spending enough of a time on the topic that is like a easygoing topic, does not have much of a length in it, but making sure that we are covering everything like a checklist, covering it off. At the end of the day, you as a student of advanced taxation must have to have a knowledge of all of that. In case you will not revise and you will just come into a live session, then this again will not be a helpful thing to you, since too many rules, too many performers, too many computations in one course we even do. Imagine the next 4 months we will have to keep on. How will you be able to remember that all at one day, the day of exam, without putting yourself, putting your heart, passion, commitment, hard work into it? Without. You've opted for the toughest of the exam, and if you have not still decided to give yourself fully to it from the very first month or for the very first course, you will start committing a mistake. It's that kind of a subject which will require to have your full of your time and energy to fit in. And you see that so many things we have done since the start of a course that to keep that in mind can be a problem even for me if I do not conduct the course every time, every session. The same thing that I do not do the next 3 months, I probably will forget in the fourth month. It can happen to me also. If I do not lecture advanced taxation, say for the next 3 months, and the fourth month I try to get back into this, I will have to once again put all of my efforts in revising it, in preparing it before I will be able to present myself. You have to see that this paper is not like a paper where there is some theories or concepts that once you have understood, so you're okay with that. It's a rule-based paper where you just need to be aware of what the rule of law is, and based on to that rule of law, how one should have to compute, prepare those performers. And a little you are not touched with, you will forget. So after all of this effort, if you will not put a little bit from your side, these 4 hours of explanation and your presence will even be a waste. I always try to explain this to students by this way, that 4 hours of explanation from my side, and you just have to plug in your 30 minutes of revision to that 4 hours of explanation. That 30 minutes plug in is not too hard on us, but it's too much rewarding. When you will just not do that and you will just follow a 4-hour lesson by your lecture, okay, and you feel happy about that, I'm taking the course every Sunday by taking this 4-hour class, as if I'm putting a lot of efforts and not going to plug in this 30 minutes of revision, 40 minutes of revision, 45 minutes of, let's say 1 hour of revision, 1 hour, not being plugged in with that 4 hour of lecture each week. This will hurt you a lot. Impact will be so big, but if you understand the importance of this 1 hour of plug in with that 4 hour of explanation, that it's never too hard on you, that 1 hour you by anyhow from the whole of the next week you can take out of your busy life, as long as you're planning your life and committing to bring that discipline where you always can have this 1 hour of revision of that week's explanation, at least in the early part of the course, first month of the course, second month of the course, where we are not really being burdened, we're not even being pressured, exams are so far. So develop this habit so that in a longer run, it will help you in tough days coming ahead. Wasting chattels. Not eligible for capital allowance and eligible for capital allowance. This capital allowance thing, you know, that is tax depreciation. And those wasting chattels, those are not eligible for capital allowances. They are totally not taxable, exempt. No tax consequences, whether the loss you have, whether the gain you have will be worked. But those wasting chattels, those are eligible for capital allowance. We have to make them tax. The gain will be worked. The losses will be worked. If you look into the application 12, first of all, how can we determine that this is a wasting chattel? And the ones we have done were non-wasting chattels. That way we can look into a nature of asset. Painting. Okay, so painting is a chattel. On the other side, it's non-wasting because the life of the painting is more than 50 years. Antique chairs. Chair is a chattel, but the word antique makes it me to say that it's non-wasting, more than 50-year life. Picture, once again, is a chattel. The life of the picture is more than 50 years. Non-wasting. Now, the moment you will read the question number 12, what will you see in it is a machine. Chattel, fine, but the life of the machine will hardly be for 5, 10, max 15 years. Cannot be non-wasting. It has to be wasting chattel. So to determine which part of the course that question has been tested from, type of asset needs to be looked at. And then machine is used in a trade. That means it's a business asset, and business assets are usually eligible for capital allowances, plant and machinery. So how the way the capital allowances are actually work, we will have a debate onto it later in when income tax we will work. But at least machine is a business asset and a plant and machinery is eligible for capital allowance. So this makes me to fall myself onto this category. They've provided to all of us with the cost alongside with the sale proceeds, and they want me to calculate the capital gain, and we easily can with the wasting chattels. So application 12 is the one we're trying to demo the first. The proceeds on the disposal are given as 55,000. The cost is given as 25,000. And there you go. The gain will be worked normally, as usually a case, nothing special in that. But now instead of gain, you have a loss. We will have to see something special. There'll be a deemed no loss. Deemed no loss means actually we have a loss, but we will be assuming we do not have a loss. And how that process of deeming will have to apply. That can be looked into the application 13. Right bottom machine for use in the trade, same like above. 20,000 has been the cost, and proceeds are hardly 12,000, which is definitely creating a loss. So actually there is a loss of 8,000 actually, but we will have to make it no loss. And how will that be achieved? Check this whole process, the way I'm going to achieve this. So cost will be adjusted. We'll have to take the proceeds into outer column and the cost in inner column. And then we'll try to adjust the cost with the net capital allowance. The net capital allowance equals to cost minus proceeds. This is how the way the net capital allowances are computed, cost minus proceeds, which will end up getting us to the same answer that we even have on the up, and automatically it has produced what? No loss. That is that process you should have to remember with when there is a wasting chattel. Gain will be worked normally as above, but the losses will be deemed to be as no loss. And how that process of deeming you have to achieve, I have been able to illustrate. And that's been written on the up. The gains are computed and taxable just in a normal way. But there'll be a deemed no loss. And this is how the way it will be achieved, deducting the net capital allowances from the cost, where the net capital allowances, they equal to cost of an asset minus the disposal proceeds. To the point, small little explanation, we have it on the way, and we are completing it by moving forward. Other wasting assets. The last category of this topic is other wasting assets. These are the wasting assets, but not the chattels in the kind. So to work the gain onto a disposal of other wasting assets, one has to depreciate an asset the way in accounting studies we do. Which method of depreciation one has to adopt? Straight line method. This is how the way the net book value will be worked, the way that we work in accounting studies, cost minus accumulated depreciation. Net book value will then be matched with the proceeds to calculate either a gain or a loss. Cost will not be, net book value. Wasting assets, those are not the chattels, not tangibles, and not movable. They fall into this category because chattel is tangible and movable. So either these wasting assets are not tangible, or if they are tangible, they are not movable, or both. They're not tangible, not movable, intangibles. Taxable, but to tax them, the way I have shown to all of you, net book value will be worked in the first place, which will be then matched with the proceeds to calculate the gain or the loss. Straight line method of depreciation will be used to calculate the cumulative depreciation. That we can apply that out into application 14 to end up this little thing also. Other wasting assets. Application 14, we are doing it under the banner of it. We have the sale proceeds, the cost. Well, the cost will be adjusted by the effect of cumulative depreciation. Tom bought a wasting asset for 25,000 on 1st of November 15. It had an expected life of 20 years. He sold that asset for 45,000 on the 1st of November 2022. 45,000 has been the balance of proceeds. The cost is given as 20,000. 25,000. The life of that has been mentioned, 25,000, which is about 20 years. How many of those years been passed by? This is 2002, 2015 was being purchased back in, and now it has become 2022. So the number of years those been elapsed or expired are plenty of 16, 17, 18, 19, 20, 21, 22, 7 of those years. So the remaining life has to be 13, and the expired life is 7. So I'll have to divide it by 20, multiply it by 7 to get me my answer. 25,000 divided by 20 multiplied by 7, the figure turns out to be 8750. Minus 25,000, the figure turns out to be 16250. It's 28750. Okay with that. So if the proceeds, imagine, are less than to what we have found as a net book value, you could have a loss. Both are accepted. The gain you have, the loss, whatever you have, both are accepted as normal. Fine. This net book working will be done in only one case. In that case is this. Remember that. It pretty much ends up the talk of another thing from this chapter. Chattels and the wasting assets are also been done. What's lined up next? A little new discussion, solely applicable to advanced taxation, the assignment of lease. But it's not tough. It should not be taking even more than 15-20 minutes to wrap this up in, or probably the 13 odd minutes. It's a little discussion. leases, the assignment of the lease. So we can plan to finish it off today based on the given time we have before the course will end today. Assignment of the lease. What does that mean? Assignment of the lease. The assignment of the lease means either the sale or maybe the gift of complete interest in leasehold property. May have been a sale or a gift of a complete interest in leasehold property is called as assignment of lease. The word assignment is associated to a case where there has been the sale or maybe a gift of complete interest in a leasehold property. The leases then can be of two types, the long lease and the short lease. Can be a long lease or it can be a short. If it is a long lease, or if it is a short lease, the gain over here will be worked normally. Gain is computed normally. But on the other side, oh, we could have a loss, by the way, so I can write it. Maybe the gain or the loss, whatever we have, is computed normally, either of the two, whatever we have. You may have a gain, you may have a loss. It will be worked normally when the lease is. What makes the lease to say long lease? I forgot to mention. The lease is the long when the duration of the lease is more than 50 years. The duration is more than 50 years. That makes this lease to say a long lease. Okay with that. And when it is less the other way around, it is a short lease. I can write it onto the other side. So when the duration is less than or equals to 50 years life, it is called as a short lease. So will the gain and loss be worked on the short lease the same way as normal? No. Might end up getting a gain or a loss. But here the cost of the asset will be adjusted, is computed by adjusting the cost. A little bit of adjustment will be required. And once the cost is adjusted, it will be matched up with the proceeds to calculate the gain and loss based on to it. So here the cost does not need to be adjusted. You just simply come to compare the proceeds minus the cost. But in the short lease, it will be. And that is what you need to understand. How will it be? And we can have a look. The sale or maybe a gift of to complete interest in a leasehold property is called as assignment of the lease. May have been a sale or a gift. Complete interest called as assignment of lease. Could be a long lease or a short, and I have explained it to you. More than 50 is a long lease. Less than or equal to 50 is short. So in the case of the long lease, the gain or loss, whatever you have, one has to compute it normally. You do not see any further text over here. But in the case of the short lease, you're watching me trying to pass on some adjustments to the cost. And this is that adjustment formula, which so easy to apply. We can apply it. The gain or loss, whatever you have, is computed by depreciating the cost, not by using straight line depreciation method, reducing, rather by using the lease depreciation tables given in exams. So there will be a table like in financial management courses, you get a table of discount factors, NOT factors. So there'll be a table of lease depreciation, which you will be using to compute that adjustment. And the cost once will be adjusted, will be able to match it up with the proceeds to find the gain or maybe a loss. That cost will be multiplied by with that fraction. In the numerator, the fraction takes the percentage of the years left on the date of disposal divided by the years left on the date of acquisition. When the lease was taken out, at that time, how many number of years were left to run before the lease expires? And on the date of disposal, how many of those years are left now? So respective values will be chosen from table of lease, and we will put them into numerator and denominator to multiply it with the cost. To adjust, the table provides the percentages for the exact number of years. Means if the number of years are left in terms of months, then we will have to do some extra calculation to find that percentage based on 2 months. Otherwise, complete years will be provided there. So I have got 2 applications. This application will have complete years, easy doing job. This will have certain months and years. So you will be able to see how will I be able to adjust the cost when it comes to months also. Just this one formula is the attention of this, is the main attention of this page, nothing else. How to make the use of that formula to multiply it with the cost. And once the costs adjusted, minus the proceeds, might end up getting a gain or a loss. In the long lease, nothing needs to be done except cost will just be original cost will just be compared with the proceeds to find the gain and loss. In the case of short, this needs to be done. Application 15 requires us to calculate the capital gains on the assignment of the lease in the tax year 22-23. So here we are, application number 15. Now, Christian sold a leasehold shop for £95,000 on 30th of November 2022. He had acquired the lease back in 2021 for 54,000, and the lease has about 44 years to run. The time it was acquired, 44 years to run. That should be the thing to consider while computing the denominator, acquisition date. At that time, the number of years to run were 44. And then a year after it has been sold, it means on the date of disposal, the number of years to run will be 1 less, 43. So they have provided to all of us with those percentages according to those number of years applicable to our question. And I'll just need to place this amount and this into numerator and denominator to get my answer done. Without you solve it, it looks, do not know, we are going to do something so much scientific stuff over here, but it's nothing. Small adjustment where the proceeds of the disposal are 95,000. And because it is a short lease, how do I say this is to be a short? Because of this reason. 44 years to run, less than 50. The cost needs to be adjusted. The cost of that is 54,000, and this needs to be multiplied with that fraction. Number of years to run at the date of acquisition are 44. So I will use that 97.529 into numerator. 97.529 into numerator, and the number of years to run at the date of acquisition will be the one less 43. So I'll be using that 96.786 in the numerator. And then whatever the answer my calculator will produce will end up the whole story. That is it. 96.786 divided by 97.529 multiplied by 54,000. It's going to be 535.89. It's 41411. That is it. Things will become a little more lengthier when we will be having years and the months. So to perform that months computation, we will have to do a little extra work in it. Otherwise, the same thing you will expect to see in application 16 now. So let's go to work the application 16 to end up this little thing on the way, the assignment of the lease. Jane purchased the lease with 46 years to run. That should be the denominator. Less than 50, short lease it is, for 65,000. On 25th of Feb, he sold the lease for 78,000. Proceeds are given. Now here, it was consistent 1st December 2020-21 all the way down to 30th of November 2022. It was the whole 1 year. It was the whole 1 year. But there it's not the case because the day of purchasing it is August, disposing it is Feb. So there's going to be a little bit of months on top of years we will have to count over here. And we can do the good analysis of that first. So let me write it without I produce a solution onto it. Let's just go to analyze. Application 16 is what we are going to attempt. So let's go to write very formally the acquisition date. And then comparing it up with the date of disposal. So the acquisition date is 1st of August 18. The disposal date is 25th of Feb 2023. So how many of those years have been expired or elapsed? Let's have a. That day it was about 46 years to run. From the date of acquisition is about 46 years to run. So how many of those have expired? From that point of mark till the date of disposal, it's going to be 19, 20, 21, 22, 23 we cannot take because that's 25th of Feb. So it's 19, 20, 21, 22, 4 years. Plus how many months? August, September, October, November, December, Jan, Feb. 7 months. So 4 years and 7 months have been expired. So I can write it over here, 4 plus 7 months. Okay, let me write it formally, 4 years plus 7 months. So remaining on that day standing will have to be 46 minus 4, 42 minus further 7 months. So 41 years plus 5 months. This should be the number of years and months to run on the date of disposal standing, 41 years plus 5 months. As this much already have been exhausted. Remaining is this standing it onto a date. So this analysis is very important before you start working the computation and all. I hope you have understood this analysis. It requires to have good observation, nothing else. So let me go and write the pro forma. The proceeds are given as 78,000 minus the cost, which is 65,000. And this requires to have an adjustment. Denominator can simply take the percentage of 46, that is 98.225, 98.225, but the numerator cannot just be 42 or 41, it's in between the two. So how can this be worked? Have a look. At least 41 years percentage has to come in. So I at least can write 95.564 over here, 95.564 over here, 95.564 over here. Let me bring that over here so that it becomes better. And then I have to add 5 months effect into it. I already have taken 41 years, and then I have to top this up with the effect of 5 months. And this will simply be a mathematics. You have to take the least percentage of 42 years, which is 96.178, 96.178, minus the least percentage of 41 year, 95.564. Let me label it. This is for 42 years. This is for 41 years. Whatever the balancing figure I will get will be the least percentage of that 1 year in between. 96.178 minus 95.564, it's 0.61, which I can simply divide by 12 and multiply it by 5. It's mathematics. You just have to take 5 months out of it. So you divide that by 12 and multiply it by 5 to get that thing. And that is 0.26, which I will simply be able to top this up into that numerator, 0.26. Got it. This is how the way that months extra will be topped up in it. This is the 5 months answer, and I have been able to get in front of all of you. Can see that how the least percentage of 42 years minus the least percentage of 41 years will give me the answer of that 1 year's percentage divided by 12 multiplied by 5 will give me that extra. So this is now 41 years plus 5 extra months to run, standing it at the date of disposal. And let the calculator to finalize the result. 95.564 divided by 98.225 multiplied by 65,000, the figure turns up to be 63408. The 63408 minus 78,000, the final and full answer has turned up to be 15592. That is it. How long has it taken to complete this explanation? It's all in front. Have you all seen it? So some of those aspects then will come to our way, will be the new aspects, but not as difficult as you may think of without covering. It's the end of this assignment of the least little talk about. So reloading, if there has been the sale or maybe a gift of an entire leasehold interest in the property, may it be a long lease, may it be a short lease, both are taxable. Long lease case is straightforward, as there the cost does not need to be adjusted. You will simply minus the cost from the proceeds to arrive at your answer. But when it is a short lease, that bit of an adjustment is required. People have seen it when the completed years are involved. How simple was that? But when the years and few months were involved, people have seen the whole way of getting that answer done. Most important thing was the analysis that we have done in the start, which has enabled all of us to conclude that 41 years by anyhow will have to come at least. We have to top them up with the 5 months effect, which is that way of finding that answer, and we did. With that, good, no problem. Getting towards to the last topic of this chapter, assets being lost or destroyed, which we will not be able to finish today, but still we can have a start of it, and we can expect to finish it off the next week when we will meet up by spending maximum 30-40 minutes on, and we'll be able to start off the further aspects. So assets being lost or destroyed is the next. Assets being lost or maybe destroyed. Destruction due to the reason of any catastrophic event, short circuit, maybe fire, flood. Losing an asset could have been because of the reason of stolen, or you may have lost it by yourself. So the first thing that needs to be looked upon in this case, the asset that has been lost or destroyed is either insured or not insured, because this will derive the whole solution. Not insured, so usually insured, business assets are insured, but what if those are not? We must have to be aware of the implication even. So starting off with a first most easy case, when it is not insured, then what is going to happen as far as the tax treatment is concerned? So let's go to make one example down below, where so if an asset is lost or destroyed, see, an asset is destroyed by fire on 20th of June 2022, which was acquired previously for about £5,000. Noticeably, the asset is not insured. Is not insured. An asset is not insured and destroyed by a fire on 20th of June 2022, which was being acquired previously for £5,000. So we will have to come and work the answer onto it the same as before. Cost, I will be able to write it like normal. Proceeds, normally we come to write when an asset is disposed. But here we cannot write since the asset is not disposed. It's rather been destroyed. On top of that, it was not even insured. So we cannot even have the chance of getting the sum of insurance on. That means the cost of an asset itself is a loss to a business. So cost equals to the loss arithmetically, and even conceptually speaking. If I have incurred 5,000 in acquiring an asset, today I just have lost those 5,000 since my asset is destroyed. That's the loss to me. And on paper, if I try to quantify the cost of an asset itself is the loss to me. 0 minus 5,000 equals to 5,000 negative. Yes, could happen that scrap value will be used if provided, will be used. In case if it is provided, in case if it is not, then cost will be a loss. But in case if it is provided, then whatever is provided, suppose 500, that will reduce the loss to a little. See, that's the first case. When an asset is lost or may have been destroyed and it is not insured, no insurance proceeds are received, so therefore there is a loss. Loss is computed by comparing the cost of an asset with 0 proceeds. Yeah, if there's any scrap value given, it then will be used being the part of disposal proceeds. Simply it's written before you read that out, I even have explained that to you. That's been asked into application number 17. And we also can revise this to finish this case. Now, Luke purchased a business asset for £20,000, which was being destroyed by a fire on 31st of December, and the asset was noticeably was not insured. So we'll have to come and write the proceeds, which I will not, since. So cost will turn out to be a figure of loss itself. There you go. That pretty much ends up the very first case and requires to have no further spending of time. Good with that? This how the way even the next case is. Insurance, we will have to learn it, but that we will keep it now for the next course. Because good that we meet up the next week and we'll take the both similar cases in a same flow. When an asset is insured, the proceeds not used for the restoration and used for replacement. Then we will land ourselves onto the assets being damaged with the same way of discussion of not insured, insured. So that section and all, I still feel it will be able to take about 1 hour of the next session. Or if not 1 hour, 45 to 50 minutes before we will be able to start ourselves with the further aspects of capital gains. And these further aspects will be in the continuation of what you have gained today. If you will not come up into a course by revising it all, what I have feeded you with, it will be a trouble. And you will start making your life difficult, troublesome from the first week of the course if you will not listen to me, if you will not pay regards to what I say, and you will just come into a course, will not be better for the health of the preparation of this subject. Even the live course explanations are more enjoyable, more tasteful when you will come up into the courses by recapping yourself with the last weeks of explanation, because this will make you connect the last week and you feel more in command. Try it out for 1 week. Come up into the course the next week with all of that talk of today. And you will see how much associated you will feel when the next Sunday we will start. You will feel as if the course was just finished yesterday night and I'm starting it off the next morning. Because actually it's not the case. We meet after 6 days. So with the gap that comes in between, for a student, it's a problem, but for me, it's not. You feel that problem out when you do not do this. Like I told you, that 30 minutes plug-in, you have taken the entire course of 4 hours today by putting effort, by waking it up early on Sunday morning and giving your Sunday to me. But when you're not going to attach this 30 minutes or 40 minutes of revision plug-in with before coming into the next course, you actually make the mess of that 4 hour of effort that right now you're doing with me. Sooner or later, you will realize it. So better you realize it itself from the first week itself. You will feel so associated with what I am leaving you at today. And by the time after 6 days when I will start. That concludes the course of today. I will continue the same old what we've been talking about in the next week, Sunday course. Have a good weekend. Thank you very much.